Let's
Come
just
on,
start.
Big Mackie.
As soon as Mackie
All
gets
right, well,
on.
we'll start here. So, good morning. We're gonna wait. We're gonna get some people in here. It is Friday, October 18th, and it is Wall Street Beats. I'm Nadine Turman, and today Paul Meeks, we have Berna Barche, Jeff Mackey, Ben Bry, and we're going to be talking about two things. We've got some tech and we've got some election trades for you. We're going to kick it off, though, with Paul. Paul's going to talk a little bit about what he learned about Netflix and then, therefore, how he thinks about playing it from here. Paul, take it away.
Well, good morning, everyone. Nadine, thanks for hosting. I'm also very interested in what Berna has to say on the topic of Netflix. We talked about it just 48 hours ago, earlier this week, with our buddy Russell Young. But the company indeed reported the results last night. You know, that was no surprise to any of us. I think we all thought it was going to be a great quarter, and whatever guidance that they gave, they don't give guidance much anymore, was going to be positive. And yeah, that happened. You know, the stock's ticking up 9 or 10% at the open this morning. What I thought about it, which was particularly interesting, was that yes, they had good news, but a lot of companies in the June quarter cycle had good news too, and their stocks went down. So now I like the fact that good news is good news, and so I think that Netflix continues to rise. Um, what I saw, which was particularly impressive, was the bulk, not the bulk, but at least 50% of their net subscriber ads came from their ad supported tier. And that's just good business. And their content lead, you would think after all these years, the maturity of the company, and with all the other competitors, their content lead would shrink over time. I think it's widening. Live sports has been really big. The content pipeline with all the money that they're spending, very impressive. And the way I look at it, you know, the best pair trade, which is so obvious to all, is continue to go long in Netflix and video streaming when you play the group at all. I don't always play it. And short all what I call the bullshit old Hollywood companies like Warner Brothers Discovery and whatever Paramount Global is after the deal that was done. And I actually think that because the pipeline for content is so strong, everybody and their brother right now is raising prices. And I don't know if that's fair for some of these other companies that have no content, but it's more than appropriate for Netflix. So I bet not in the near term, but in the next couple of years, they rate price it again successfully. And so you got a nice flywheel here. You know, they have the money to spend on content. Content drives engagement. Engagement drives revenue. Spend some more money on content. And that's why this virtuous flywheel is spinning faster than ever. And you would think, maybe counterintuitively, that after all these years, they feel some heat. I actually think that their lead's extended. So that's what I like. Of
So
course,
Paul,
I
I
like
want,
to
I
buy it
want to
on
press you
the
on this, though.
day, but I still like it.
I want to press you a little bit on this. So, because valuation matters too, right? So it's one thing to say they're going to be a leader, they can spend on content, content will continue to strengthen their moat. But how do you think about valuation? Because at the end of the day, you got to make money in the stock, right? And
Yeah.
maybe it's not about valuation and multiples, it's just what they do versus expectations. But now with this kind of print, and then basically for next quarter, raising for top line and margin guidance greater than expectations. Now that's baked in, right? That's going to be baked into this 9.3% price change that I'm looking at right here. So how do you hold this or get into it if you haven't been into it?
So that's an excellent question. You know, the first thing I do is I just hold it. You know, I've held it for years, so I'm not going to buy it on a day when it's up 9 or 10%.
Sure.
But, you know, as the winds blow in technology and as the winds blow, particularly for this company, it is inevitable. It's happened again and again and again that I'll have a bad day and then maybe I'll come in at that point. And then there's another thing I mentioned just now, which I think is important, is Nadine, sometimes I don't even play the theme at all. Right. So if I go there, I'm going to go with Netflix. I'm going to piss on the other old Hollywood names. But sometimes I don't play it. And, you know, obviously I'm not buying it fresh here.
Right. And then Berna, what are your thoughts on the quarter and thinking about the security itself?
I mean, it was perfect, as close to a perfect quarter as you could get. I mean, the only thing you could pick apart is you could say, oh, the Latin American region was a little weak for them. Okay, fine. Otherwise, the margin story, I think, is playing out, beyond anybody's dreams. And I think it's going to get better. They're in this sort of sweet spot where you have, as Paul said, competitors are raising prices without really having the value proposition for the customer, which really is going to give them the license to raise the prices. I do think that there's going to be a ceiling on what people will pay for this service. When you start, people wondered, could they break the $20 barrier? And they did, on the premium plans. The question is, can they break the $30 barrier? I'm not sure about that, but I think it doesn't matter, because I think if people hit a price pain point, they'll switch to the advertising supported tier. And that AVOD tier is actually going to monetize actually higher for them than the subscription tier.
That's what I was going to ask you. So it's even better if people switch to the ad model, is what you're saying?
Yeah, they win both ways. And so the ad model is very important, overseas, where in some of the developing markets where you really can't get the price out of people. But I think, the concern was, well, what about, is it going to cannibalize, in the UK, North America, Western Europe? But, you're going to end up monetizing higher on the AVOD piece. So they win either way. So nothing to not love here except for the valuation. And so when I talked about this on Monday, I talked about how I was out, having bought the stock around 187, a couple of years ago when it had that crash in May. And, so I just missed 10% here. But I think there's I don't feel bad at all about it, because I made 3.5 times my money in a couple of years. And so if I'm not there for the last 10%, God bless, maybe I was in David Buster's, which is also up, just as much in the last couple of weeks. That's fine. There are a couple of reasons I sold this. One, and I literally have nothing negative to say about this company. It's a great company. I also sold my Apple not that long ago. I have nothing bad to say about Apple either. I do think, and this is kind of old fashioned, and I think Russell would make fun of me for this, I think valuation matters. And it's 26 times EBITDA, next year's EBITDA, almost 8 times sales. Maybe it's going to beat numbers by 10%. It's not going to beat numbers by 30 or 50. So that's really rich. I believe I will own Netflix again for all the, everything that Paul said, I agree with. And, I just don't feel like I need to own every stock and even every great company. And I think that there'll be an opportunity for me to, it sounds crazy now. I think I'll buy it with a 5 handle again, because there'll be some quarter where they, lose up. Yeah. And, if the market, and one of the reasons that I let go of this stock and let go of Apple is, anyone who's been watching our chat, I think Ben and Robert and, a few others have made very good arguments for why this rally in the market may not continue forever. And so when I think about possibility of a correction, I don't do as much shorting as I used to. The way that I protect myself is I raise my cash and I get out of the stocks that I think are most vulnerable to a correction. And, even though this company will probably be relatively recession resistant, it is on a great secular path. It's just a very highly valued, highly owned, high multiple company. So right now I am looking for idiosyncratic kind of, I've talked about Five Below, we've talked about Dave and Buster's, I talked about Petco, I'm looking for idiosyncratic self-help kind of situations where the companies are down a lot and not up a lot. And, even if the market crashes, maybe not crash it, but even cracks, they can still conceivably go up because they have the opportunity to improve their results from a low base right now. And you know what? And if the market, corrects or crashes and is 10, 20, 30% lower, I will be looking to, rotate back into these higher quality names like Apple and Netflix or Nvidia, things that are too high valued for me, because, it just is a matter of risk reward, right? And, okay, if they how much more multiple expansion are we going to get? So if they beat by 10% next year and, they grow 25%, maybe the stock will be up 30%. But, it's not inconceivable that there's, a 20% multiple contraction here either. So the
Sure.
risk setup isn't there for me right now. But
Right. Yeah.
amazing company. And I agree. I really was very vocal about how I didn't like the company at $600, back around 22, right before it crashed. And, it's a much better company now at 750 than it was then at 600. Their moat has increased. And this whole AVOD story has really emerged and was something that didn't exist a few years ago. So it's better at 750 than it was at 600 a few years ago. But it's just still too rich for my blood here.
Got it. Yeah, and that's why I brought it up, right? Is because you can like a quarter, you can like what management's doing, but what are you going to do with the stock? At the end of the day, that's what we're here for. That's what our subscribers are here for. And there's a lot of non-consensus folks here on Wall Street Beats, and that's how we play it, right? We want that Build-A-Bear. We want all the retail that maybe people either don't know or have been hated for so long. So thank you very much, Paul and Berna, to walk through Netflix. We're going to switch over to Jeff now. Jeff, what are you looking at?
I'm dancing with the girl that brung me. In that case, in the last month or so, it's been these consumer plays. We've talked about them before. Regarding Netflix, I'm long in my kids' account. We talked about that. You kind of hold your nose. You want to go contrarian, dumb it down. Take the valuation out of it. See that purple crayon over my right shoulder? Draw a thick trend line underneath it. When the stock goes below that, get the hell out of Dodge and just let it correct. Otherwise, if you start thinking about what they're doing per sub, you're kind of playing the wrong game. You'd be out of this stock 300 points ago, 200 points ago, and so, but what we're seeing, what we saw this week, saw better than expected retail sales. And we see the consumer that we've been talking about, super discretionary, getting a little picky on the highest end. But overall, they're going back to kind of tried and true stuff, left for dead companies. I like Gap. I like basically them all. I think we're going to have a better Christmas than expected. I don't think it matters who's in the White House in terms of the incremental spend. We have nice, big, ambiguous catalyst in front of us because these companies are going to be reporting better than expected earnings, and the margins have been solid all along. Right. If I'm going to, so it's. Listen, we're sitting here with Play having been up almost 20% in the last 5 days. We talked about that last week. It's the kind of market where it's easy to feel like a genius. I'd rather feel like a genius at 5 times EBITDA to enterprise value than I am going anyplace else. And so, you add new positions and stuff that's cheap, and you balance it out by kind of either paying for it with your winners or just getting out. But I think right now the prevailing message is this market's broadening out. You can complain about it. There's not everything to love, and there's a chance of an election shock downside risk. But you know what? Until any of that happens, we're seeing really good price action. We're seeing the market kind of broaden out, and you're getting a pause. This is kind of Netflix's day in the sun. I still like Amazon, and it's still not a great valuation play, but the name hasn't gotten so far ahead of itself that it's just become this extended kind of hyper value thing. And so you're not chasing it up 10%. You're chasing at levels that we saw in July and we saw in June. It's just taking a pause that refreshes. And that continues to work for a consumer that, we've talked about it for months. If you get a little tailwind, all of a sudden these things are really cheap because you're going to get multiple expansion across the consumer place. If you wait for those numbers to come in, you're going to miss the stock move. And sure enough, these stocks have been moving kind of right into data that is going to give a tailwind. People are going back to the mall, hanging out at Dave & Buster's. Who doesn't like Pac-Man and booze and betting on sports? Bad people, evil people don't like those things, Nadine.
It's funny because just so folks know, I put out a free daily note. It summarizes global news with a little bit of humorous bent. But one of the charts I put in there, and I thought of you this morning, was looking at the services retail spend. So food and drinking places. It looks like the 3-month average of the monthly change rose in September to its best level ever since last November. So, you've been talking about retail, restaurants, and the like, and people are spending there. So when you look at that,
and you can think about it, you can super overthink that, and you can say they shouldn't be, and the country's vibes are negative, and you can come up with all those kind of touchy-feely things. As it turns out, they're spending. They're going in and they're buying stuff, and we have the best consumers in the world, damn it. So why don't you bet on America a little bit? That's my message for a Friday.
Where's your
Very
flag?
good.
Where's
Run
your
for
flag?
office.
It's a metaphorical behind me. It's you can
That's
picture it.
right.
You can hum
I can
America
see
the
it
Beautiful.
waving with the eagle screaming. All right, now on to Ben. Ben, I know you've got an election trade for us. Walk us through it and walk us through it slowly so that everyone can, stay along with your mind as it moves fast here on the election trade, the multifaceted election trade.
So take a breath first. Is that what you're saying?
Yeah.
Okay. So for people who follow our subscribers, know that I pitched Fannie Mae around $4 or sub $4 earlier this year, and then in August, post the at the what I call the Kamala peak, I pitched Geo, which is a private prison company. So just to start with, Fannie Mae is a servicer of everyone's mortgage. It's the reason why we have 30-year mortgages, and the American dream exists. To go back to Jeff's America theme. And then Geo is a private prison company that will benefit quite a bit with Trump when he's going to put all the immigrants into prisons. I know this is a little dark, but it is what it is.
Slightly darker turn in the America theme.
Here. So if you pull up the first chart, you can see this is the kind of the way you think about it. The orange line is the predicted market, and then the Fannie Mae is the white line, Geo is the purple line, and then one thing that I like is Geo divided by First Solar. Obviously, the Dems are big solar advocates, and Trump is obviously more on the private prison side. They're very different people. But if you do the relative trade, you can see we've had a big swing down, and now we've come up. Now, one thing I want to show you next is the reaction of Fannie Mae and Geo post the election. We move to the next chart. It's not a great chart. It's my fault. But basically, you can see that Fannie Mae was up almost 2 or 3 times, and Geo was up 2 times. I'm thinking this time around, we're going to go probably Geo will go initially to 25 to 30 right away, and then we'll trade up to 45. Fannie Mae will probably trade in the $10 to $15 range. Remember, this is a preferred stock, so its face is at 25. So they both have 3 to 5 times, tails. So here's the trade. Go to the next chart, please. If you see what's going on in the poly market, and since you're on Twitter, can you go to the next chart, please? Okay, here we go. Kamala futures, the binary futures on the poly market, which you have to trade with crypto. But last night, I actually went long those at 38 cents as a hedge against this. And I think, based on my view of the distribution of outcomes, which means there's convexity on all these bets. So Kamala is 2.7 times, Geo's basically 2 to 3 times, and Fannie Mae is 3 to 5 times. I think if you're long all of them at these prices, you're going to win no matter what. And since a lot of us view that we're all losers in this election, this is a way that we can all be winners.
So thanks for that, Chuck. So walk us through, you quickly went in there that you need crypto to do the Kamala trade. So can you kind of go step by step, if someone's new to that, exactly what they would do?
Yeah, so here's the story, which just ran on Wall Street Journal today. It was on X a couple days ago. A guy put out a thread, and he'd done some sleuth work, and he basically found that there was a whale in the poly market, which is skewing Trump to the upside. And this guy's a genius. I think this guy, whoever this guy is, basically he put $25 million to work in the poly market. And remember, these prediction markets, there's real money. I think there's like maybe $2 billion total waged, but it's illiquid. So you're going to move the price around a lot. And there's not enough supply to offset that. So you will get an inefficiency, essentially, right? Because remember, markets are supply and demand at its forefront. The arbitrageurs of old, aren't there always in markets, as we see the Mag 7 trade at 1 billion times earnings. And there's no one to arbitrage these things.
Right.
Am I here?
Got to bring it back. There you go.
There we go. And so this guy came in, put $25 million to work and drove it up. But what the theory is that by that high frequency prediction market, then DJT doubles, and DJT has a lot of short interest. DJT has a lot of options against it. So there was a bit of a gamma squeeze. So if you were a wise guy, which this guy might have been, Fannie Mae and Geo were up 20%, but those are real companies. That's we're not dealing in DJT fake stock world. But if you're trying to make a trade, you buy options or you take your position in DJT, then you spend your 25 million in the poly market, and then you drive it up. And then if you drive it up, you get sentiment to change. And then if you are on Twitter, you're seeing, oh, Trump's at 58, Trump's at 60, Trump's, whatever. And it creates a momentum. And then you just can nicely get out of your DJT right here. And then, let's just say this is a coin flip of a market or an election, 52-48, 50-50, whatever. You can ride so you had $12.5 million of expected risk and you've already cashed out. Total genius trade. I bow to that guy. But
or lady, just in case, just saying.
Yeah. We have some nice smart ladies here, right? Or could be a lady. That's fair. But
now that they're up, I mean, can people still make money from where Fannie Mae and Geo are today? You still think? I mean, I know you've been in it.
If you go back to my chart that lays out the trade for a second, you can see what I think the expected returns are. And let's be clear, Fannie Mae preferreds have a $25 face, so it actually could be 5 times to go to face, and it has $13 of dividends in arrears. So that would get you to $38. Okay, Geo, I think, will go to $45. Now, Geo was at $35 in 2016, shortly after the election. So you're talking about, 2 to 3 times your money from here. But yeah, I mean, the easy trade of like, oh, Pete Kamala, pre-event trade, yeah, it's richer now, sure. I mean, they're up 20-25%. That was more of a sentiment trade. This is an event trade, right? This is saying, hey, you can go into this event with both sides, and I think you make money. Obviously my targets are estimates. They're not facts.
Yeah, right. This is where your guesstimates are the asymmetry.
Yeah, exactly. And then if we go, one other thing you want to see, let's pull up this next chart on the dollar versus Trump, just to point this out. You can see that's a very clear correlation. We've had the DXY almost to 104 again, which is above August 5th. And there is some smart guys who run funds and stuff that I talk to that are saying behind the scenes that Trump's going to do a 1985, 1986 move and really rip the dollar. And so I think that's some of this what's anticipating. And one thing I would add that I don't think is very well appreciated is that I think Trump will be deficit hawk. And I think the deficit comes down under a Trump election. And I know a lot of people don't think that, but the odds of a GOP sweep have been increasing. And if these guys come in and they cut things and then rates are coming down, and let's remember every 100 basis points of interest rates dropping is $100 billion of savings because 40% of the debt is within 1 year. Okay, so it accrues very quickly. And that's lost income for all the people who are enjoying their free money in the money market. So there's a little bit of a flywheel because remember, public deficits are private surpluses. I'll say again, public deficits are private surpluses. So when the government pumps 7% of GDP to keep the economy up, well, that's why you have S&P earnings where they are. That's why you have the stock market where it is. If we reverse that, like we did on an incremental basis in 22, I'll tell you what happens. Assets go down, bonds rip, and the dollar will rip. And so we'll see how it plays out, but it's worth watching this quite closely. It's there's the Trump specific thing, but then there's the larger piece of the puzzle.
The big trend, right, with policies, but then that can take a little time to play out, but people will start to connect the dots whenever actions start happening from whoever wins. Sorry, go ahead, Ben.
You lost me a little bit on something, which means you could be losing other people. In a loosening, rate cut environment, how is the dollar going to surge? Is that related to tariffs? How are you going to be simultaneously loosening and having a dollar appreciation?
Well, because this is something that's not well understood. Rates going up is risk expansionary. Rates going down is risk off, risk contraction. Actually, let's bring the last chart up. I can show you this. The the dollar, can we bring the very final chart up? You see here now what this is, the dollar is in the blue line, the DXY, and then we have the three spread trades. We have the Mag 10 in yellow divided by the S&P. Then we have the Mag 10 in green divided by the Nasdaq, and then you have in pink the Nasdaq divided by the S&P. And what you can see as the dollar rises, the spread, which is the multiples and the performance, because this is the normalized performance, drops. So if we have a rising dollar, the dollar will come, the rates basically are trying to offset the credit contraction. And so the credit contraction in a world that's 3 times levered, 2.5 times levered, there's simply not enough dollars, okay? And so they're going to try to get rates down while this collateral contraction happens. So they happen simultaneously.
Got that, Werner? Other questions?
I'm still not convinced on how the dollar.
Well, so let's talk about the.
How does the dollar appreciate when rates are going down, unless the entire world is cutting rates?
I'll simply just give you 2 examples. In 2008, in the GFC, the dollar ripped and rates dropped to 0. In COVID, the dollar ripped.
But that was a flight to safety situation.
That's how the financial system works. It's a collateral-based system. As everybody upgrades their collateral, they go to treasuries and they get rid of spread product, which is the NASDAQ, which is credit spreads, which is all this stuff on the wings, and you go into treasuries and cash, and you buy dollars at discounts, which is SOFR and bonds, because you want dollars. We go into a dollar bull market. Right now, we're in a dollar bear market. No one wants cash. And I have a million charts on my Twitter account, if you want to see, of cash as an allocation, as a percentage of the households, is at the all-time record lows, right? So as people get nervous because uncertainty rises about the future, then essentially you go into cash, and then credit contracts, and then to try and offset that cascade, rates come down.
Mm-hmm. Okay, and then my other question is your assumption on the deficit, reduction is completely counter to what happened in the first term. And I understand the different dynamic around Congress, but are you saying I believe we'll get the cuts on the budget, but you don't think we'll get the tax cuts that then offset that and lead this to be at best deficit neutral?
So I have a few things on this. First, I think that the one thing that AI can bring to the government is reducing fraud and improving tax collection. And I think that if you look at the CBO put out a report that showed 2.2 to 3% of GDP is lost every year from fraud and waste. Okay, so that alone can be a huge deficit reduction without changing any services. Let's just make the system more efficient. Now, Elon is obviously Trump's biggest backer, and he's talking about having a government efficiency audit. There is so much waste that goes on at the government level of like $50,000 toilets that are sold to the government with enormous margin. You can cut all that. Like I watched a podcast of a guy who's a former Navy SEAL talk about he could cut the DOD deficit or spending by 1/3 and have no change in the output. So there's just a ton of fat and a lot of people who are gravy training this, and they can cut that. And you know what? That's why there's such a hate for Trump, because they know that their gravy train could end like ours did in the GFC in 2008. Everyone likes the gravy train. Everyone likes the party to keep going. And so I would say that just that alone can do it. And then you have the rates, and then you have maybe some ending of some of this ridiculous spending that's been going on by this administration. They're a little bit out of control, these guys. They like to party.
So you going the long dollar from here? Because you've got your trade here.
Yeah, I'm long the D SOFRs 25, which is just a discounted dollar, right? So you got that at 96.60, and that could be at par. There's a chance we could be back at a 0 or 1% interest rate world. And by the way, it doesn't have to be a dead economy either, because then you would get the refi, and there's $20 trillion of home equity that's sitting out there that can be put into the economy. So if we get rates down and we get the curve back disinverted, but you can see what's going on. The long end sold off again. And I said this on the show the day before the Fed. I was like, I'd sell the long end right here. And what did we have? We had a huge bond sell-off. And so they need to get that curve disinverted in order for banks to be able to buy this and be able to make some money. And then, if it comes down, then it should be very positive for, basically the guys who want to refi. And perversely, though, that could actually be a disaster for the housing market, because I think that 70%, 65% of the mortgages are struck below 4%, right? So there's just people stuck in their homes. So yeah, people can refi, but it also could bring on a wave of supply. And that finally, I'll tie this bow a little bit, and that's why I think I've talked about Better Financial, BETR, and then Rocket Mortgage is obviously the premier company in this. But the refi guys are a way to have a convex bet on that outcome.
Okay. Well, thank you. So, I know we're getting pretty long here, and I want to make sure everyone can enjoy their Friday. I know Mackie's itching to go golfing over there. So thank you so much for joining us. We're going to catch you back Monday, but today was Friday, October 18th, 2024. I want to thank Ben, Jeff, Berna, Paul, and the team behind Wall Street Beats. And if you like what you see and you want to get more on some of the details and notes, go to wallstreetbeats.com, subscribe, and you'll get a lot more from the folks here and others on our team. Thank you.